Welcome to The Physical Edge, a series of interviews about the physical gold fund and the intricacies of the physical gold industry with Alex Stanczyk, Managing Director of Physical Gold Fund. Hello, I'm John Ward on behalf of Physical Gold Fund. We're delighted to welcome you to the first in a new series of podcasts we're calling The Physical Edge. In these interviews, I'll be talking to Alex Stanczyk, Managing Director of the Physical Gold Fund. Our focus will be the fund itself and related questions about the physical gold market. So this series is primarily for non-US investors who are considering participation in the Physical Gold Fund. Alex Stanczyk has been involved in the Physical Gold Fund since its inception, providing core aspects of the fund design and structuring, as well as coordinating the strategic relationships required for launching the fund. Prior to this, Alex played a key role as designer and advisor to the world's first non-bank private custody precious metals fund, the Luxembourg Precious Metals Fund. And for the past 8 years, he has served in a range of capacities for the Anglo-Far East group of companies, focusing especially on the logistics of gold acquisition, transportation, and vaulting. Throughout this time, Alex Stanczyk has lectured globally to institutional and government audiences on the role of gold in the international monetary system. Alex, welcome.
Thanks, John. Thanks for having me. And I want to thank you for hosting these interviews. You've done a really great job with our other series, The Gold Chronicles, which is very popular.
Well, I'm looking forward to this new series, The Physical Edge, because it gives us a chance to drill down into some of the questions that our listeners may have about the Physical Gold Fund and related topics. So let's begin with the big picture. Very simple question. Why gold? Many people argue against gold as an investment simply because it fails to produce any kind of yield. Let's look at that question first.
Sure, that's a really great question because it's extremely common. In my view, it's actually a common error, and it happens mostly amongst financial professionals when it comes to gold, in that they view gold solely in terms of nominal performance measured in currency terms compared to stocks, bonds, and other types of assets instead of looking at it for its insurance properties. So in other words, as you say, they say gold has no yield. This is most often due to a meme that was started by Warren Buffett that unfortunately has been memorized and repeated by a lot of financial professionals, but it's not really consistent with the facts. So if you, for example, took dollars and you were to stick them in a vault somewhere, there's costs associated with that. That vault costs money to build, security costs money, etc. Just like gold, if you stick gold in a vault, that also costs money. And I think this is what the essential basis of their argument is. But also, like dollars, that's true unless you invest it somewhere. So in other words, dollars don't have a yield either unless they're lent or invested. If you put dollars in a bank, you're essentially lending those dollars to the bank. And these days, your returns in interest might be pretty horrible. The same is true of all money. So in gold, you can actually lease gold out and get a return on it. It's called the gold lease rate, is effectively the yield. So the most important part about this is that the meme is really a straw man, and it distracts people away from the point as to why to allocate to gold in a portfolio, which is insurance. If a person takes the time to think it through, this is obvious. Many people think of the gold price as gold's value in dollars or some other currency, but the reality is that gold's value over long periods of time does not change much in purchasing power. It's really, to me, the gold price is currencies measured against gold. So some examples of this gold versus currency in purchasing power terms is if you go back to, say, 1913, and you look at the U.S. dollar from then to now, the U.S. dollar has lost over 95% of its purchasing power. And you look at the price of gold, you go back to 1913, the purchase price of gold in U.S. dollar terms was $20.64, the official price. And today it's sitting at about $11.80. So that would be a gain of about 5,600 plus percent. Another way to say it is that if you were to have the same purchasing power of $20.64 back in 1913, today you would have to have $496 to be able to buy basically the same amount of goods. If you bought a house back in 1913 for $100,000, that same house today would cost you $2,403,000. And if you held cash, you would have lost over 24 times the purchase power. In contrast to gold, if you had invested $100,000 in gold in 1913, that would be worth $5,717,000 today. The question comes up, what are the main reasons that gold is such a strong medium for storing value? And a lot of that has to do really with its physical properties. So in particular, gold is a noble metal, and what that means is it's resistant to corrosion. It doesn't interact with oxygen. It's very difficult to destroy unless you actually alter it on an atomic level. It could be dissolved with certain chemicals, but the dissolved atomic particles that are in the chemical are still gold. So it's different to other commodities. Some people refer to it as a commodity, but it's very different to other commodities, especially like, for example, iron or wheat, in that it doesn't decay. If you threw a lump of iron into the ocean, over time it would corrode. But gold can sit there for thousands of years, even hundreds of years, and it's still going to be gold. So some of the largest institutional and sovereign wealth managers in the world agree that gold acts as a diversifier and a truly non-correlated asset. So what we're talking about here is not the nominal performance of gold. We're talking about it in terms of counterparty risk and liquidity. So if we drill deeper into that, what we mean here is that typical portfolios are highly stacked in equities and bonds. These assets are highly correlated when it comes to systemic risks. So they have things in common, such as they require, for example, functional electronic markets or exchanges. They require a need for financial services counterparties to remain solvent and provide liquidity. They require a dependency on prime brokers or banks to remain functional, and they require government regime stability. So I find that many financial professionals do not really weigh systemic risks heavily into their equation. And the thing is that nowadays, with the way markets are functioning, the debt levels of governments, etc., I would argue that markets are far more unstable today than they've been in history. But an example that I like to give is that I've recently been over to China talking to many of the largest hedge funds and fund managers over in China. And a common response from them is that they're not really concerned about having their assets in the banking system or having their assets on the stock exchanges, etc. And they didn't really have any backup plans for that. Well, that was a really good recent example. As the Chinese stock market crashed, the government stepped in and basically said to all of them, you're just simply not allowed to transact in these markets. I know of fund managers who I've spoken to personally who said that they ended up having to write letters to their clients, essentially telling them that their funds were non-liquid. So these are the kind of things that we're talking about, and they happen in reality even in today's markets. Some might say that U.S. markets are far more robust, etc., but the reality is that liquidity is lower now than it has been in very, very long time, and this is a concern. So additionally to that, as far as why gold, basically it's a bedrock, so to speak, of the monetary system. There was a recent interview with the executive director of the Central Bank of Austria, and that tells us a great deal. Essentially, he said that central banks hold gold for two primary reasons. The first is as a liquidity buffer, and the other is as security. So the role as a liquidity buffer is obvious, but if you would have to dig a little bit deeper to find statements by central bankers about the security component. What they're really talking about there is that the gold that they hold is a backstop for confidence, and it means it's what they would use to restart the system, so to speak, should confidence in paper issued by governments fail. So this implies both liquidity and value at the same time. Finally, gold has some of the deepest liquidity markets in the world. The daily turnover in the gold markets is close to half the dollar volume of the largest equity markets in the world. Gold is the only hard asset you can buy with these kind of liquidity properties. So our view is that gold's purpose in an investment portfolio is to serve as an insurance policy. So gold acts as a hedge versus the impairment or loss of liquidity in financial assets like stocks, bonds, or even values in currencies. When you see there's some recent examples such as the Russian ruble or even the Brazilian real where their currency is plummeting in value, where in gold the gold value is skyrocketed in those currency terms. So it's actually preserving wealth for people in those currencies who had invested in gold. So we're willing to admit the risks that we're talking about here in probability terms are pretty small, but the size of the risks in terms of portfolio impairment are potentially really large. And these risks do represent a probability greater than zero, and it's trending higher. So if a person's a fiduciary and they have not taken these scenarios into consideration and planned accordingly, then it might behoove them to take a look.
Well, let's assume that we begin to understand more fully the principle of systemic risk. We take it more seriously. We want to organize a portfolio to take that into account. One argument might be, well, I'm already doing that. I have a balanced portfolio and I have basically some instruments that function as hedges or as safe havens, such as cash or treasuries. How does gold compare with these alternative ways of securing a portfolio?
Sure, John. So let me give you a little context to explain as far as how we view it. We look at gold as money, so not in the sense of daily transactions, but in the sense of being a basis for the monetary system in terms of both storing value and in terms as a reserve asset. So according to the IMF, and this is a really important thing to understand, is that the IMF says the gold bullion component of monetary gold is the only case of a financial asset with no counterparty liability. So what we're talking about here is that essentially it doesn't require some counterparty such as a bank or a financial institution or a government to perform for it to retain its value. Also, in a recent paper, the IMF places gold highly on its list of reserve assets. So even above SDRs and above the currency of sovereigns, it's listed as a reserve asset. Gold is considered monetary reserves by central banks, and it's forming an increasingly important component of reserve balance sheets. Emerging market central banks are continually adding to their gold reserves. China and Russia are essentially leading the way here, and they're consistently buying well over 10 tons to upwards of 30 plus tons a month. The CIA fact book, it lists foreign reserves and gold when it's looking at country strategic financial resources. And regardless of what people's personal opinions of former Fed Chair Alan Greenspan are, he did have some pretty high visibility into the inner workings of the global monetary system for a very long time. And his quote was that gold is a currency. It's still by all evidences the premier currency where no fiat currency, including the dollar, can match it. So as far as how it performs versus cash or treasuries, the thing that people have to keep in mind is that gold is in stark contrast to any kind of a financial instrument that is the liability of a financial counterparty. And those types of instruments can be affected by a number of things. So, for example, exchange stability, an electronic exchange or platform, those things can be subject to cyber attacks, for example. Not only that, the recent volatility and specifically lack of liquidity in both bond markets and equities markets is something of great concern. HFT could be argued, high frequency trading could be argued, that it has caused a great deal of instability in electronic markets these days. So other things that could be issues is the solvency of financial counterparties. In other words, if whatever assets you're holding relies upon some other financial counterparty to perform, then those are real issues with those assets being liquid when you need them to be.
Well, let's say, Alex, that we've embraced the idea now of insuring against systemic risk, and we've embraced the value of using gold as part of that insurance. It would seem that there are two basic ways to buy gold. We can own the actual metal, or what seems to be actually more common is we can invest in paper assets that are backed by gold, such as ETFs. Could you tell us briefly about the paper gold market and the difference between owning paper assets pegged to gold and owning the metal itself? How do these two market sectors compare in performance?
Essentially, there are a lot of ETFs and other type products on the market which are designed to give you price exposure to gold. And there are many people in the gold community who refer to these products as paper gold. And essentially what they're saying there is that indicating that they believe that they're essentially paper promises in terms of being unable to perform when it comes to gold's function as insurance. So again, this is looking at the counterparty. So for example, many of the ETFs or gold funds that are out there in the market today, they're clearing through banks, meaning they're buying and selling their gold through banks. And that's not a problem as long as those banks stay solvent, and that's not a problem under normal circumstances. But if for any reason those banks had some kind of liquidity problem, or those banks during some kind of financial crisis ended up being unable to trade, just like back in 2008, if there was a hedge fund that was dependent upon a prime dealer or a broker to clear their positions, and that particular institution was insolvent and unable to trade, they were essentially out of business. So this is what a lot of people are referring to when they talk about these kind of things. And our view on that and our position on that is that we've tried to create a structure where the risks to that kind of thing happening are at an absolute minimum. And we don't trade at all. There are no leverage positions in the fund. So essentially what happens is that when people send money in, they want to buy shares in the fund, that money goes directly to the refinery, which then purchases physical gold. We're not speculating. We're not using any kind of unencumbered positions or unallocated positions. Everything we do is 100% fully allocated physical gold. Every single share that we have represents a portion of the underlying physical gold assets of the fund. And there's nothing that the fund does that could possibly create that kind of a situation where there is risk. We also have taken steps to mitigate the risks that, for example, other funds have when they're buying and selling through banks.
So, Alex, understanding this distinction between what folks sometimes call paper gold and the metal itself, understanding that, let's turn to the physical gold fund itself. What exactly is this fund? To what extent is it physical? To what extent is it paper?
So the physical gold fund is a tool to invest in fully allocated gold, fully allocated physical gold. It has distinct advantages over other funds that are essentially giving exposure to the price of gold. Some basics about what the physical gold fund is that the gold essentially, number one, is vaulted outside of the banking system. We use some of the world's top security logistic companies to do this. The gold is currently vaulted over in Switzerland as our primary vaulting jurisdiction, although we have the ability to add other jurisdictions over time as needed. The gold is insured to the full value of the metal, regardless of what the price is doing. But in addition to that, it's also insured versus political risk, and I'll explain more about that in a couple of minutes. We have exclusive protocols in place to purchasing metal as well as liquidity, which completely bypasses the bullion banks, as I said a little while ago. And shares of the fund are redeemable for either cash or you can take delivery of the gold itself. So in quantities as small as 1 kilobar, the fund will ship those to you when you go to redeem your shares if that's what you choose.
So this seems to be an important distinction. What you're saying is with the physical gold fund, there's a one-to-one equivalence between the share and the metal, whereas we know that in the paper assets that are associated with gold, those that are familiar on the market, there is not often that exact one-to-one equivalence. There's often a kind of a multiplier effect. Is that correct?
Well, sure. Some funds in the market will use leverage. They'll use other kind of derivatives or tools to trade the price of gold, and their objectives are a little bit different. What they're trying to do is achieve some kind of price return, that performance return in excess of what the gold price is doing. The way our fund works is that essentially there's what we call a NAV, so net asset value. So essentially that's the value in currency terms of all of the gold that the fund owns, and there's a certain number of shares that are issued. So each share is issued at what we call the NAV, or the net asset value, which is a dollar figure, and each share represents a specific amount of gold in the fund.
So let me ask you this. Why did you and your colleagues feel the fund was needed? What gap did you see it filling?
I was looking for answers to the problem of continually falling purchase power before I really knew anything about gold. So, as a young man, I set goals as to what I wanted to earn, believing that when I reached these goals, it would basically mean certain things in terms of buying power, etc. So, when I finally reached these goals, I was really disappointed to find out that the purchasing power was less than half of what I thought it was when I made the goal. And this was, of course, before I understood anything about inflation and how it erodes purchasing power over time. But this really bothered me because I knew that on a societal level that couldn't continue to function over time, and eventually it would just cause certain issues. So, of course, this led me to studying money and ultimately to gold and why it holds purchasing power better than other currencies typically. And when I was learning about gold, I quickly realized that this ability to hold purchasing power extended over very long periods of time, even generations. So, to your question, I mean, if we're honest, the economy could be a lot better. There's central banks that are conducting essentially what comes down to experiments with monetary policy that have not really seemed to have done much. And if investors were to look at that in terms of combining that with negative interest rates or zero interest rates, it's hard to see how value can be protected for most people. And gold just makes sense. So as it pertains to the physical gold fund, we took a hard look at how gold funds in the market were structured. We found a number of items which didn't quite check the boxes. When we were looking at this from a perspective of gold functioning as insurance, because that's how we view gold's purpose, and then looked at these various different funds in the marketplace, we started to realize that they had certain things that prevented them from actually fulfilling that role when it was most needed.
Could you tell us a little bit about those differences? What makes the physical gold fund distinct from the alternatives that are, as it were, closest to it or most equivalent to what the physical gold fund is about?
When we looked at the various funds in the market, we compiled a lot of information about how they were structured. Our concerns primarily came down to what we found that could be improved upon. This could read like a list, for example, of due diligence questions that an investor might ask about any gold fund that they were considering allocating to. So first of all, we wanted to know, how is it vaulted? And this comes back to the counterparty question. And as I mentioned before, most funds, in fact, every fund that we found in the market today is either vaulting with a bank or a quasi-governmental institution of some sort. And the banking situation was something that concerned us. So because gold has to be able to act as insurance, you want that to be able to perform when it's needed. And as I mentioned before, if you're holding your gold with a bank and that bank has issues, then there are potential problems with your fund having issues if you're vaulting with a bank. So then there's also, in some jurisdictions around the world, there's legislation that's been passed called essentially bail-in legislation that allows banks to confiscate essentially the assets that it's holding to recapitalize the bank in event of failure. So this is another concern as well. The way we do it is a physical gold fund, as I mentioned before, is vaulted outside the banking system with private security logistics companies. The point is that if there's major interruptions in the financial markets or if there's solvency issues with service providers, we're seeking to reduce the impact of these factors. The next area that we looked at was how is it insured? And most funds in the market that are vaulted with banks, the banks will carry a general insurance policy for the overall business. This may not cover the value of the metal itself. So the way we do it is that we have an insurance policy that covers the value of the metal specifically, regardless of how high the price goes or how much metal that we're holding. We obviously looked at auditing, and that's one area that we were not comfortable with is in some of the prospectuses that we looked at, in fact, the biggest ones, they are unable to audit the vaulted holdings of any sub-custodians that they may have. So this was a big red flag for us. Our fund doesn't use sub-custodians. And in terms of auditing, we use several auditors. One of them is Grant Thornton. It's one of the largest auditors in the world. That is our bullion auditor. So that what they do is they handle anytime we do what's called a bailment. So gold going into the vault that we've purchased, they're present. They check off the gold against all of the serial numbers that are provided from the refinery. And in addition, if we ever have to take gold out because we're liquidating it, they're there for that also. And then Ernst & Young is another auditor of ours. They do one random audit annually where they will drop in at the gold vaults, unannounced essentially, or announced on very short notice. And they'll go in there and they'll do their own audit, but they also do the overall audit for the fund's financials. Another thing that we looked at is physical redemption. We considered this to be a pretty important aspect of a fund. Many of the biggest funds in the world, you can't redeem for the gold. So in other words, you can only get cash back out. Some people feel better about the ability to take delivery of the gold directly. And other aspects of that are some of these are restricted in the ones that do provide physical delivery. Some of them you actually have to go over to Switzerland to pick it up, for example, or you have to go to a specific jurisdiction. And there are also limits on the size of the gold bars that you can redeem. So with our fund, we will redeem gold bars as small as 1 kilo, and we have the ability to ship that essentially anywhere in the world. We have a pretty large footprint for our security logistic. We're able to send that pretty much wherever somebody might want it. Other things that we looked at is there was nothing in place anywhere to insure versus political risks. So risks involving unrest, etc., loss of physical access to gold. This kind of thing has been completely unheard of in gold products. And what we learned is that it's unheard of because it's very, very difficult to get. We've taken a proactive approach to this. We essentially picked up an extra level of insurance that covers the gold in the event of war, riots, some other kind of civil unrest or government intervention which prevents us from physically accessing the gold vaults, as well as government confiscation. So if a government were to try and get assets of the gold fund, we've got an insurance policy actually that covers the value of the gold against that. It's underwritten by a Lloyd's of London syndicate, and it took us a long time to get that in place. So as far as I'm aware, we're the only gold product in the world that is doing that or that has that. My guess is that's soon to be copied. And then finally, we took a look at how does the fund handle clearing risk. And this was a big one because what we found is that every gold fund in the world is buying and selling through bullion banks, essentially. Or some of them might access futures markets, but as far as we could tell, they're all buying and selling through bullion banks. That was a big red flag for us because if your fund is clearing and settling through bullion banks, you have a great deal of clearing risk. If something were to happen and that bank was unable to buy or sell your gold for whatever reason, essentially your fund is dead in the water. We reduce this risk by bypassing the bullion banks completely. So the way we do that is that our fund is buying and selling the gold directly through some of the largest LBMA certified refineries in the world, primarily in Switzerland. On the other side of these refineries stands not only financial services counterparties like banks and etc., but jewelry demand, which makes up some 50% of global demand for gold on average over the last 5 years. So this, we think, is a really important feature of our fund. And as far as we are aware, it's unique in that aspect, and it just provides kind of an extra degree of security for our investors to feel safer that they're going to get liquidity on their gold when they need it.
So Alex, who is the physical gold fund primarily designed for?
Physical gold fund is designed for anyone who wants to make an allocation to physical gold, who is also conscious about how that is structured in terms of counterparty risk, how it's vaulted, where it's vaulted, liquidity risks, things of that nature. There are 3 different share classes. The first share class is the A class. The minimum for that is $500. The second share class is the B class. The minimum there is $100,000. And the I class, the minimum is $500,000. The differences between the 3 classes are the fees. So on the front end of the A and B shares are a little bit higher than the I shares. And the thing about the I shares is that they're essentially competitive with the GLDs of the world. So they're very low cost in terms of annual fee, but with all of the added advantages we already talked about up and above how other funds are structured in the market.
So if an investor decides to participate in the gold fund, what are the steps? Could you briefly walk us through the subscription process?
Sure. Physical Gold Fund is listed on the Cayman Stock Exchange. It clears through Euroclear and FundSettle, as well as Pershing. If a person has a brokerage account or a bank, that has access to those clearing platforms, as well as if you deal with a Swiss bank, there is a Swiss velour for the fund where they can access on their platforms to purchase the fund. Aside from that, you can also go directly to our fund administration company, which is Trident Trust. And if you want information about that, you can just go to physicalgoldfund.com and click on the How to Invest tab, and it will give you contact information for how to get in touch with Trident Trust, and they will walk you through the subscription process. It's pretty straightforward. They'll send you over subscription documents that you'll complete. You do a wire transfer to our cash custodian bank, which is CIBC Cayman. They hold back a small percentage for fees, just for essentially operating expenses for the fund. Then the rest of that is sent over to the refineries directly to purchase the metal, and then shares are issued to you. So when you're ready to redeem those, the process goes in reverse. And you can decide at that time whether you want to take cash. If you want to take a redemption in physical gold, then you would contact the administrator and you would go through the process to fill out the necessary forms to request a physical redemption. And the fund would take a look at your requirements and figure out what the logistics are there and get it shipped out to you.
Well, thank you, Alex Stanczyk, Managing Director of the Physical Gold Fund. And thank you to our listeners. We look forward to joining you again soon. You have been listening to The Physical Edge with Alex Stanczyk, presented by Physical Gold Fund. Recordings can be found at physicalgoldfund.com/podcasts. You can register there for news of our upcoming interviews with Alex Stanczyk. Physical Gold Fund SP is a segregated portfolio fund managed by Physical Hard Assets Fund SPC and regulated by the Cayman Islands Monetary Authority. The fund's investment objectives, strategies, purchase options, applicable administration fees, management fees and expenses are contained in the offering memorandum. Please read these documents carefully before investing. Investment funds are not guaranteed, their values change frequently and past performance may not be repeated. Information presented in this interview has not been independently verified by any stock exchange or regulatory authority and is not intended to be and must not alone be taken as the basis for an investment decision. No representation or warranty, express or implied, is made, and no reliance should be placed on the accuracy, fairness or completeness of the information presented. The information contained herein does not constitute an offer to sell or solicitation to purchase securities of any issuer or any portfolio managed by Physical Hard Assets Fund SPC in any country or jurisdiction in which it is not legal to do so.